Welcome to the Deep Dive. This is where we take a stack of interesting sources, articles, research, our own notes, and really pull out the key insights and maybe some surprising facts. Our goal, like always, is to give you a shortcut to being well-informed, without feeling totally swamped. Okay, let's unpack this. Today, we're diving into some really fascinating material that shows just how fast things are changing. We'll look at how we work, personal finance, the big global tech race, even corporate accountability. It's quite a mix. So first up, we're going to explore the new world of work. The whole job hopping thing seems to be over, replaced by something we're calling job hugging. Then we'll dig into money and markets, drug pricing, some interesting accounting quirks, things that really affect your wallet. And finally, we'll shift to that intense competition in tech, especially AI and space, and what it all means for global power, right? So the labor market. We all remember the Great Resignation, right? Felt like everyone was quitting, but now it seems like the pendulum has swung completely the other way. We're seeing this. Great stay. People are, well, the phrase being used is clinging to jobs for dear life. Job hugging. Kind of funny, but also maybe relatable.
It really is a shift, yeah. If you look at the numbers, the labor department's quits rate, it's been stuck around 2% since early 2025. And apart from that initial COVID shock, that's consistently low. We haven't seen that since like early 2016. And ZipRecruiter's polling backs this up. Job seekers feeling not confident at all about finding something. That's jumped. It was about 26% 3 years back. Now it's 38% in Q2 2025. So yeah, there's just not much churn happening. And why? Well, several things are feeding into it. There's definitely nervousness out there, economic uncertainty, political uncertainty globally. Plus, the job market itself has cooled off. Higher interest rates make it expensive for businesses to grow, to hire. The actual hiring rate is the lowest in over 10 years. And remember that ratio of job openings to unemployed people? It was 2-to-1 back in March 2022. Now, June 2025, it's roughly 1-to-1. And look at CEOs. For the first time since 2020, more are planning to shrink their workforce 34% than expand it, which is only 27%.
Wow, okay. So it's not just a feeling. The numbers really show people are staying put.
Yeah.
But what's the trade-off here? What's the human cost or maybe the hidden opportunity cost of all this job hugging? Because, staying put feels safe maybe, but it sounds like there could be real downsides.
Oh, absolutely. It's a bit of an economic paradox, isn't it? You seek stability, but you might actually be hurting your long-term finances. Job switchers usually get bigger pay bumps. So if you're hugging that job, you could be leaving serious money on the table over time. And then there's the stagnation risk, not learning new things, not taking on challenges. That makes you less marketable later when inevitably the market does pick up again. So yeah, the safe choice now might limit you later. And it definitely makes it harder for, say, recent grads to get that first job.
That's a really important point. The safe choice having hidden risks. Does this anxiety, this shift, show up in retirement planning too?
Yeah.
We hear a lot about people planning to work longer, right, just to afford it. Something like 70% considering delaying retirement. And nearly half are worried they just won't have enough money.
Yeah, that's the plan for many, but reality often gets in the way. The data's pretty stark. About 58% of people retire earlier than they planned. Why? Well, almost half, 46%, it's health reasons. Another 43%, employment issues, like losing their job. The hard truth is, like they say, the labor market doesn't always want you when you want the labor market. Age discrimination is real, skills change, and this is all happening when traditional pensions are mostly gone. People rely on 401ks, and those can get hit by unexpected costs, student debt. It adds up.
Right, so the plan to just work longer might not be foolproof. So if people are facing these pressures, what are they doing now? Which brings us to this really unexpected indicator you mentioned, pawn shops. It's kind of startling to think of them as a place for back-to-school shopping. What's going on there?
It really highlights the pressure, doesn't it?
Yeah.
Items in pawn shops can be, up to 50% cheaper than buying new, and almost all of it, 98%, is pre-owned. So no tariffs, that's a real saving these days. We're also seeing a big jump in people pawning gold. Gold prices are up, 27% since January, around $3,400 an ounce. So families are literally selling old jewelry to get cash for school supplies. It's often a sign of financial stress for people who maybe don't have easy access to regular credit. I mean, national credit card debt is holding steady, around $1.2 trillion. But this pawn shop trend, it suggests a lot of people are really struggling day to day. There was that quote from Les Gold, the pawn shop owner.
Oh, yeah.
He said, "You can't imagine what's going on in the economy right now unless you live in the pawn shop."
Wow, that says a lot. Yeah, unless you live in the pawn shop. That really paints a picture of an economy maybe hidden beneath the headlines. And speaking of things not always being what they seem on the surface, let's pivot a bit. Let's talk about money, markets, and specifically a drug we hear a lot about, Ozempic. Novo Nordisk just made a big move, didn't they? A huge price cut for cash-paying patients in the U.S., down to $499 a month. That's, what, less than half the list price, which is almost $1,350. And they did something similar for Wegovy, too.
Yeah, it's a fascinating example of how the pharma market can be forced to change. It wasn't just one thing. It was kind of a perfect storm. You had significant political pressure. President Trump was very vocal about drug prices, right? He even told that story about his friend paying $88 in London versus $1,300 in New York for a fast shot.
Right, I remember that.
Then there's fierce competition, especially from Eli Lilly, Zepbound, and Mounjaro. They're really effective drugs. And you also have the rise of these cheaper compounded copycats they need to fight off. So politics, competition, and disruptive alternatives all coming together. It really challenges that idea that drug prices only go up. And the market noticed. GoodRx partnered with Novo on this, and their stock shot up almost 37%.
Politics, competition, copycats. Quite the mix forcing their hand. Shows how dynamic things can be. But are there other ways companies, maybe especially retailers, manage costs that aren't so obvious, like with tariffs? Does that always show up straight away in their profits?
That's where accounting gets interesting. A lot of big U.S. retailers, think Walmart, Target, Home Depot, maybe nearly a quarter of them use this method called the retail inventory method, or RIM. Think of it like averaging. Instead of tracking the cost of every single widget, they use an average cost for big categories of stuff. Now, here's the key part. When costs jump up suddenly, like with new tariffs, this averaging method can actually make their recorded profits look better than they really are. For a little while, it takes time, maybe 2 to 4 quarters, for those higher costs to fully average in and show up accurately. It's like turning a cruise liner. It takes time.
A lag, basically.
Exactly, a significant accounting lag. It can hide that immediate hit. Walmart even mentioned RIM when they pulled their profit forecast recently. This was around the same time President Trump said retailers should just eat the tariffs.
Okay, so this RIM accounting gives them a bit of a cushion, at least on paper, delaying the bad news. But that sounds risky for investors, doesn't it, if the profits aren't quite real yet?
It definitely is a risk. If you're just looking at the headline profit number, you might not see the underlying cost pressure building up until later. It's not just some internal accounting detail. It can absolutely affect how the market sees the company and what it thinks it's worth down the road.
Interesting. Okay, let's shift again. Another area where things might not be as straightforward as they seem. Alternative investments for regular folks. Platforms like Yield Street promise to let people invest like the 1%, get into things like real estate deals, private credit, things usually off limits. But how's that actually working out?
Well, the reality has been pretty rough for a lot of investors. There's the example of Justin Klish, who put $300,000 into a Nashville real estate project via Yield Street and lost it all. And CNBC did a review, looked at 30 real estate deals on the platform. 4 were total losses. Another 23 are on a watch list. They found $78 million in defaults already recognized.
Oof. Why such big losses?
Mainly rising interest rates, the Fed hikes hit hard. That pushed down property values, especially multifamily, which dropped like 19% since 2022. Plus, many of these deals used a lot of borrowed money, leverage, which magnifies losses when things go south. And there's been controversy, too. Yield Street sent out confidential updates, apparently sometimes reporting things like a 0% return when investors actually lost everything, a netted 100% loss. They also got fined by the SEC over a different offering related to marine loans for not disclosing clear warning signs. Now, Yield Street is kind of pivoting. They're aiming to be more of a broker, offering products from big names like Goldman Sachs and Carlyle, moving away from doing the deals themselves.
Wow, $78 million in defaults. That really drives home the risk.
Yeah.
Investing like the 1% clearly doesn't guarantee earning like the 1%. And it's interesting because making these private market investments more accessible, even in retirement plans, is something President Trump has pushed for. It raises big questions.
Okay, let's zoom out now to the really big picture, the global tech race, particularly AI, U.S. versus China. This feels like the defining competition right now. It absolutely is, and it's incredibly high stakes. Sam Altman, OpenAI's CEO, he's been warning pretty directly that the U.S. might be underestimating China's progress, especially, he says, how fast they're building out inference capacity. That's the ability to actually run the AI models efficiently. Altman's also pretty skeptical that just controlling chip exports will work long term. He worries about workarounds, about China building its own chip factories. This worry actually seems to be driving OpenAI's strategy now. They just made a big move releasing what they call open weight models.
Open weight. What does that mean exactly?
It means they're making the underlying parameters, the core components of the AI model, public. Anyone can look at them, build on them, modify them. It's the first time they've done this since GPT-2 back in 2019. It's a major shift from keeping everything proprietary.
That is a big shift. Why do that? Why give away the keys to the kingdom, so to speak? What's the strategic thinking there?
Well, the underlying fear seems to be this. If the top US AI models stay closed off and China keeps advancing rapidly, maybe even with their own open source models, then the world might just end up relying on Chinese AI because it's accessible. So OpenAI releasing open weight models is kind of a strategic bet to keep the US ecosystem dominant in the OpenAI space too, not just the closed proprietary one. It's complicated further by politics, of course. President Trump recently okayed NVIDIA selling its H20 chip to China, even though he called the chip obsolete.
Right. And how did China react to getting these supposedly obsolete chips?
Kind of lukewarm, actually. They put out warnings about security risks, which NVIDIA denies. They discourage their own companies from buying them, but China still needs chips like this. Their own companies, like Huawei, can't produce nearly enough yet. And NVIDIA's software ecosystem is really dominant. So it's a complex dance. And this whole AI race, it costs unbelievable amounts of money. Just look at the spending. Meta dropped $17 billion on capital expenditures in Q2. Microsoft, $24.2 billion. Google's parent, Alphabet, is planning $85 billion for 2025 capex. It's almost all going into AI infrastructure, data centers, chips. Goldman Sachs estimates that just the power needed for data centers globally will jump 165% by 2030, mostly because of AI.
$85 billion for Google.
Yeah.
The scale is just mind-boggling. And it's leading to some unusual partnerships, right? Like Google investing more in TeraWulf, a Bitcoin miner. How does that fit?
It's all about finding or building that infrastructure quickly. Bitcoin mining needs huge data centers and tons of power, right? Well, AI needs the exact same thing. So Google increasing its stake in TeraWulf, providing a backstop that could reach $3.2 billion for one facility. It lets them tap into existing or planned infrastructure that's suitable for AI. TeraWulf gets funding, Google gets capacity. It's potentially worth up to $16 billion in revenue for TeraWulf. It just shows how different industries are getting pulled into the AI build-out.
So AI is reshaping things on the ground, massive investments, power demands. But it's not the only frontier facing pressure. Our global connectivity, things like space, internet, cybersecurity, they're seeing turbulence too, aren't they? Even space internet had issues recently.
That's right. Starlink apparently had an outage on August 18th. That was its second hiccup in just 2 weeks. And this is happening even as SpaceX keeps launching satellites like crazy. They have over 7,000 operational now. But the expansion itself causes friction. You've got the California Coastal Commission pushing back on more launches from Vandenberg, citing environmental worries. Meanwhile, President Trump signed an executive order trying to ease environmental rules for commercial space launches. So tension there too. And then shifting to cybersecurity and geopolitics. There's this situation in Spain that's raising eyebrows. A deeply troubling deal, some are calling it. Spain's Interior Ministry gave Huawei a 12.3 million dirham contract to store judicial wiretap data.
Wow. Wiretap data with Huawei, given all the concerns.
Exactly. U.S. Republican lawmakers are calling for the Commerce Department to investigate, to review intelligence sharing with Spain. They're citing Huawei's known ties to the Chinese Communist Party and the potential risks, even mentioning importing crypto risks into the regular financial system, which is quite a statement.
Storing judicial wiretaps with Huawei. That does sound deeply troubling, especially for intelligence partners. Is this just a one-off weird deal, or is it part of a bigger pattern we should be watching?
I think it highlights a much broader ongoing tension, the clash between grabbing economic opportunities with, say, Chinese tech versus the national security risks that come with it. As more countries use technology from companies with strong state links, it just inevitably forces hard questions. Questions about data security, who controls it, how reliable intelligence sharing can be, and whether our alliances can withstand these kinds of digital vulnerabilities. It's a constant balancing act now. So if we try to, tie all these threads together, what we've really seen today is how interconnected everything is. Our personal job choices, the price of medicine, how retailers do their books, the global AI race, even who stores wiretap data. It all blurs together, from job hugging and pawn shops to accounting tricks and AI spending to space internet and security deals. Every piece tells part of this bigger, complex story.
Yeah, exactly. So what's the takeaway for you listening? We've covered a lot. Why your job feels more like a hug, maybe. the surprising reasons drug prices might fall, those hidden accounting details shaping giant companies, and this intense AI race playing out everywhere, from massive data centers right up into orbit and even tangled up in sensitive government contracts. So here's a final thought to leave you with. In a world where even economic data can get politicized, where small choices ripple outwards in big ways, what new strategies do you need, personally, professionally? How do you navigate not just the headlines, but also these hidden currents we talked about, to stay truly informed and ready for whatever's next? Thanks for joining us for this deep dive. We hope you'll keep exploring, keep asking questions, and keep digging into the information that shapes our world.